instead of receiving income and paying a ton of tax on it, or instead of selling investments and paying capital gains, they just take a loan out and borrow against it and use the loan to fund their expenses. And they let their assets continue to grow. Now, the benefits here are the loans are not, you don't pay income tax on a loan. So when you loan against something, you get $100,000 all of a sudden in your checking account. You don't pay tax on that. It's a loan. So there's no income tax owed. Your tax liability can stay super low. Anyway, it's used very commonly. Another thing that's often talked about in terms of infinite banking is when you get into retirement, they talk about retirement income. Instead of withdrawing money from different accounts or assets, you actually just take loans from your whole life insurance policy and then use that to fund your expenses. And you technically never have to repay the loan, really. You can just take more of a loan as long as whatever's in there is still enough to cover the death benefit. Okay, so it can blow up if you don't have enough money to cover the death benefit, right? You could get into some trouble there. And if you do, then the money you've taken out in loans actually can be realized as income. And then you would owe taxes on all that money plus interest. So there is a way to blow this up, and you have to be careful about that. So that leads me into the next topic, which I'll cover really briefly. But you can do that within a whole life policy or any other thing. You can put up any asset as collateral, and banks will give this to you. Now, you have to be very careful. These are things to be aware of and really think about. Few whole life policies are structured to do this effectively. I've seen a lot of policies, and generally, they're getting the most amount of death benefit for the least amount of premium, right? We want to keep the premium cost low and get the most out of it. Well, what does that mean? It means that the majority of the premium is going to the death benefit and very little is going into cash value. So even though agents make a killing on whole life insurance, it's just the bottom line is they make a lot of money selling these policies, and that's why they push it so hard. And so they sell you, this has happened to multiple clients of mine. They come and say, oh yeah, we bought this policy because he sold us, he talked about the strategy, and we look at the policy and it's not designed to do infinite banking. So they get the most amount of death benefit for the least amount of premium so that it doesn't seem like it's too expensive. But then most of that is going to fund the death benefit. Very little of it is actually going to the cash value. And so it's going to take many, 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 many years to build up any type of cash balance inside that policy. Okay, so that's one problem. If you max fund it and you structure the policy in a way that you do the least amount of death benefit for the most amount of premium, what happens is it becomes funded, the whole policy becomes funded really quick. The insurance agent actually earns way less commission on that type of a policy. Okay, they earn way less if it's structured properly. So there is a conflict of interest. A lot of agents are told to sell this strategy, and then they sell a plain old policy that actually is not effective for that strategy and is still going to pay out a large commission. Okay, so this is one thing to keep in mind. It's tricky and subtle, and I hope you got that. Rewind it if you need to. So the other thing that kind of comes into this is if you are going to go this route and you're going to max fund and just start shoveling a ton of money into this policy or multiple policies or whatever, you have to understand this is a long-term commitment. Okay, you are committing to the long term because it's not going to pay off. Your break even here, it might not pay off for 10 years. It may take that long for you to be able to effectively use the strategy. And so if you're not committed, if you start a couple of years into it and then bail, you're kind of worse off. You're moving backwards in a way. So it's kind of one of those things that it's effective if you are fully committed over the long term. And then it's only, again, effective if you then use the cash value to purchase assets and get the money moving twice. If you just leave it all in there accruing at 5%, that's fine, but you probably could have done better elsewhere. Okay, so if you're not actually going to go through the effort of borrowing against the policy and then using it, then you might be, you're still getting some guarantees, obviously, so that's valuable, but you might be getting less growth than you anticipated, okay? So that kind of brings me, you're still getting the guarantee of the death benefit as well at the end. But if you structure it right, the death benefit is not very large, okay? You can get a ton of these policies. That means you have to have a ton of cash flow, right? Like you have to have a lot of cash flow to be max funding a ton of these policies when getting a little death benefit. So it's still guaranteed, but just remember it's a lower death benefit. Now, you are giving up some long-term growth potential, like I said. If you use this underlying asset, you are getting a guaranteed but lower growth rate on your money. If you use a different type of asset, then you get higher potential returns, no guarantees. Okay, so you just got to understand the risks and the trade-offs there in terms of what your underlying asset is. Okay, but this strategy is very effective overall, lending against assets and using them to purchase more assets. Again, you have to be careful not to over leverage and things like that, but that's why you have collateral. Okay, so if you do this with a HELOC and then your home value drops and you have to pay it back and you don't have the cash, then right, you go into foreclosure. If you borrow a ton of cash value and then something happens where you have to start paying premiums again, and then you don't have the cash because your investment didn't work out, and then you still have to make interest payments, right? You see where this goes. Like, you can still over leverage and you can still get yourself into trouble. So you have to be careful about that, okay? The last thing I'll mention here is infinite banking does not work incredibly well with index universal life, okay? We talked a little bit about that, where instead of, because you might say, well, instead of growing at 5% guaranteed interest, why don't I just have that money, invested in underlying indexes and maybe get more growth, right? We talked about a cap, usually a floor at 0 or maybe even 2% or something like that, and then a ceiling at 9 or 10% or something. You could do that, but the problem lies in the fact that if the market goes down significantly and you don't have any more cash value in there, then you still have to pay it back, and you might get into trouble with your death benefit. They might adjust it down because you don't have enough cash value to pay the premium. So if you're not paying the premiums and the interest on the loan, then things could get really dicey. Okay, it's much more risky of a strategy doing it that way within a policy. Okay, and then the only other thing is the interest rates sometimes are different. I've seen the whole life insurance where you can loan against the cash value, but it's an 8% interest rate, which is actually pretty high given our current market environment for interest rates. Whereas you can go get an S block securities-based line of credit at 2.5% is the last number that I saw at one firm. Okay, so interest rates matter as well, and they're not always optimal in one or the other. So anyway, I hope you got a lot of value out of this, because this is a big, confusing topic. There's a lot of people that strongly advocate it. Usually they sell whole life insurance, so they have an incentive there. There are a lot of people that are strongly against it. Usually those are traditional financial advisors that make their money based on securities instead of life insurance. But a lot of them are very reasonable because some policies are just terrible, and you really have to just watch out for it. So get multiple quotes. If you're going to go this route, ask around, network around, and find groups that specialize in this. They all say they specialize, so you have to be careful. Get reviews that specialize in structuring the policy this way and ask a lot of questions. Okay, so hope that was helpful. We'll wrap up this topic there. All right, guys, see you in the next video.
Long-term thinking creates better financial outcomes.